attendees from the chat box. So if we don't write our names for virtual meeting, there is no way we can send our names and number to Ican for award of credit number. So I just say, let me put that out there so that we can do the needful. As we are on this call, please put down your name and membership number in the chat box. Thank you very much. Technical Secretary, over to you.
Okay, good afternoon once again, my professional colleagues. This afternoon, we are pleased to have one of our own in the name of Oluwatobi Okonwa to speak to us on subjects of IFRS beyond compliance this afternoon. And sorry, I'm trying to get something. So we will be speaking on the topic of beyond compliance, harnessing the strategic value of IFRS. So we have our own Toby Okonwa who will be speaking with us this afternoon. Just permit me to quickly go through our profile for us. Toby holds a Bachelor of Science in Accounting and a Master's in Finance from Lagos State University. Our academic background provided a strong foundation in financial principles, accounting practices, and strategic financial management. During her studies, Toby developed a deep understanding of financial reporting, investment analysis, and corporate finance, equipping her with the skills necessary to excel in complex financial environments. Toby's professional journey began as an audit trainee at Gabriel Luchesi & Co. Here, she received foundational training in auditing and tax practices, laying the groundwork for her future career in accounting. In this role, she assisted senior auditors in conducting audits, verifying financial information, and learning essential audit procedures. Building on her experience, Toby transitioned to domestic operations department at First City Monument Bank PLC. Here, she honored her skills in banking operations, adding a wide range of tasks, including transaction processing, account reconciliation, and fund remittance. From 2017 to 2022, Toby served as a semi-senior associate at Adeni Jagbola & Co., a chartered accounting firm. Here, she played a pivotal role in financial statement preparation, audit supervision, and tax consultancy. Our responsibilities encompassed private and public audit, tax planning, client communication, and budget planning. In 2022, Toby assumed the position of supervisor at Crusader Sterling Pensions, where she oversaw various aspects of pension administration. Toby has been an integral part of Quest No Services, a company she founded with a vision to provide exceptional training and consulting services. As a trainer, she's meticulous, design and delivers comprehensive accounting training programs tailored to diverse audiences, from junior staff to seasoned professionals and clients. Toby's expertise encompasses a various wide range of topics, including financial reporting and so on. Toby's unwavering dedication to excellence is evidenced by the consistent positive feedback she received from participants, affirming the effectiveness of her training programs in enhancing knowledge and skills. Currently, she brings her extensive experience to SIO partners, where she serves as a senior audit professional. Please, permit me to hand over the session to our speaker today, Oluwatobi Okonwa, as she takes up the floor right from now. Thank you.
Yeah, thank you very much. Thank you very much for this wonderful introduction. I really appreciate that. Sorry, am I audible? Hello?
Yes, very audible. Very.
We can hear you.
Thank you very much. Please, the slide, please.
Yes, we can hear you.
Yes, please, let's project the slides. Mr. Bodman. Okay. So thank you very much for having me this afternoon. A good afternoon to everyone, and also starting on the existing protocol. So we can begin now. All right, before we proceed, I have some analysis to put on. One of the biggest challenges in accounting is the question how and when to apply international financial reporting, that is IFRS, in financial reporting. And as a professional, we understand the critical roles that accurate financial reporting plays in decision-making and building of trust with stakeholders. A short story before we proceed. There was a passionate event planner called Emily. Emily is all about making events extra special for clients. Before she gets into IFRS, that is International Financial Reporting Standard, Emily will book revenue the moment a client signs an engagement, no matter when the actual event took place. However, everything changed when Emily embraced the principle of IFRS under IFRS 15, where she discovers the importance of recognizing performance obligation. I know someone wants to ask me, what is the meaning of performance obligation? Performance obligation is that specific thing you promise your client to deliver. That specific businesses you promise your clients to deliver. And as an entrepreneur, a white-collar job, office job, that task you have been given is your performance obligation. That job description you see. After stating in the interview, you can multitask. You can work under pressure. Is your performance obligation under IFRS 15. And as an entrepreneur, that excellent service you promise to your clients to deliver is your performance obligation. I know we have some entrepreneurs in the house, so this standard does not let us behind. We are also included. So Emily started recognizing revenue over time as a team deliver each aspect of events and customers were satisfied. So IFRS helped her create a true picture of how well our business was doing, now showing the importance of each event in the company's finances. So thanks to the changing power of IFRS. A quote, IFRS is not a challenge, but is an opportunity for financial leaders like you and I, chartered accountants, to display our commitments to accuracy. I repeat, IFRS is never a challenge, but is an opportunity for financial leaders like you and I to display our commitments to accuracy. So good afternoon, everyone. My name is Oluwatobi Okuma. I currently work with SIAO Partners, where I utilize my expertise as a chartered accountant. Oluwatobi experience cuts across different areas such as auditing, accounting, training, and then also a consultant. And throughout my career, I've been heavily involved in training professionals, and which has equipped me with a valuable skill set that I'm eager to share with you all today. So Oluwatobi will be your guide for the next 45 minutes or thereabouts, and I'm excited to be here this afternoon. And a big thanks to Igds, the Model District, for this wonderful and great opportunity for me to showcase my insights and expertise. So thank you very much, and thank you all for having me. And then to all participants today, let us be rest assured that we are here to learn, unlearn, and relearn. So thanks for having me. So the next slide, please. Let's begin. That's the table of content. Thank you. So today, we'll be looking at the topic beyond compliance and as the strategic value of IFRS, covering various aspects, which includes the overview of IFRS, the key differences between IFRS and initial GAAP, objective and challenges of IFRS, the key standards that affect financial statements, introduction and components of IFRS 15. Then we talk about the contract cost. Then we have a key takeaway for today. And by the end of this training section, I believe we all have a comprehensive understanding of what IFRS is and then beyond compliance. So let's go to the next slide. Let's go to the next slide. Let's talk about the overview of IFRS. The overview of IFRS. Sorry, the next slide, the overview of IFRS. Let's go. No, you're going down. Please, let's go up a little. Overview of IFRS. The overview, just the overview. All right, thank you. That's fine. So, International Financial Reporting Standard is a set of accounting standard that is developed and maintained by International Accounting Standard Board, that is IASB. Yes, this standard covers different parts of financial reporting, such as recognizing, measurements, presenting, and also disclosing of financial information in the financial reports. So we have some key examples, which are IFRS 9, which is a financial instrument. We have IFRS 15, which is a revenue from contracts with customer. Then we have IFRS 16, which is leases and so on. So what are the key differences? To the next slide, please. Let's quickly look at the key difference between IFRS and the initial GAAP. The key differences between IFRS and the initial GAAP. The next slide, please. Bagnos, are you the one operating it? Please, let's be fast because of our time. Yes, let's briefly talk about the differences. There are key differences between IFRS and the initial GAAP, especially in the area like revenue recognition, the lease accounting, financial instruments, and also insurance businesses, and so on. So, initial GAAP is a rule-based system with a specific guidelines with less flexibility. While IFRS is a principle-based, which allow more interpretation in financial statement that brings about transparency in financial reporting. So, the GAAP was developed by the Financial Accounting Standard Board, which is the FASB, and this is a standard for US public companies, which means that businesses that operate globally needs to comply with both IFRS and the initial GAAP, depending on their operations and the branches they operate on. So let's briefly look at the objective of IFRS. To the next slide, the objective of IFRS. Number one is global standardization. Global standardization, that is uniformity of standard. IFRS aims to create one set of high quality accounting standard that everyone around the world can use, because if there is a uniform standard to benchmark and compare performance with similar companies, will be very easy. And also, it will assist the investor to be able to identify the companies they need to invest their money on for higher return. Let's briefly look at the second one, which is transparency and disclosure. Transparency and disclosure, which means clarity. Clarity. So one of the main goals of following this principle is to ensure. So one of the main goals of complying with this standard is to make sure financial information is easier to understand, clarity. This will provide a clearer and detailed insight into company's financial performance, which can also help to build confidence of the stakeholder and the shareholders as well. The next is relevancy and reliability, that is important and correct. You know, important information help stakeholders to make smart decisions, while the accurate information is when it's free from errors. Now imagine you are an investor. How will you feel when you discover that the financial position you are holding, the financial statements you are holding, is full of error and mistakes, how will you feel? So this is exactly what IFRS aims to address: reliability and correct. So let's briefly look at the challenges of IFRS. What are the challenges in which the standard entails? Number one is complexity of standard. Complexity of standard. You know, IFRS rules can be quite complicating at times, and it will require a solid understanding of accounting. You know, also following this principle correctly might be challenging, especially for companies with complicated transactions. You know, there are some companies operating in a specific industry, such as a construction company, finance, technology, and so on. They might find it difficult to comply because of their complex transactions. So let's briefly talk about data quality and integration. Data quality and integration. You know, sourcing for information and data to align with the standard might be difficult to achieve at times. No, most especially for big companies with different branches all over the world. For them to be able to sort data from different angles to comply with this standard may be very difficult for them. So let's look at impact on IT system. What is IFRS impact on IT system? You know, IFRS is being reviewed on a regular basis. And to ensure that company software aligns with this standard, needs to go, the system needs to be upgraded. Upgrading the system will be required. So trying to upgrade the system sometimes may destroy the regular operation of the company. So this becomes what? A big challenge to industries. So let's talk about the resource constraint. The resource constraint. You know, having enough resources, both financials and personnel, to comply with the standard can also be a little bit of challenge to some companies as well. It may involve training of staff and also upgrading of technology, which SMEs businesses might not be able to afford. Compliance with IFRS is expensive, so they will be struggling with it in order to comply. So let's look at transition challenges, which is the last challenges here. The transition challenges, that is, switching to the local GAAP, switching from the local GAAP to IFRS can be tough at times, most especially for companies that have a complicated system. It takes a lot of planning and teamwork to make the transaction happen. So let's quickly look at the next slide, please. The next slide. Let's look at the key components, the key components that affect financial statements. You see, we can't talk about a standard without examining the financial statements, because this is where the standards are required. This is where the standards are applied. So let's briefly look at the balance sheet, which is the statement of financial position, which shows what the company owns, that is their assets, and what they are owing, which is their liability, and what is left for the owners of the business, which is the equity. So the standard affected by this component is IFRS 10, which provides a guideline of consolidated of financial statements, and also IFRS 16, which addresses the recognition and measurement of leases. Let's look at the income statement as well, which is the statement of profit or loss, which shows how much money company makes, that is their revenue, and also how much they spend, that is their expenses, and whether it now ended up to be more money or less, give us the net income or loss. So the standard affected by this component is IAS 1, which is presentation of financial statements, which will be replaced by IFRS 18, effective on or after January 1, 2027. And also we have IFRS 15, which we are going to talk about today, our revenue from contracts with customer. Let's briefly look at the cash flow statement. The cash flow statement is segregated into cash inflow and cash outflow, which have three categories. We have the operating activities, who talks about the revenue generating activities such as the sales and services. Then we look at the investment activities, which talk about the investment in asset like equipment and property. Then we look at the financing activities, which flow from the financial transactions such as acquiring long-term assets, investment, or debt repayment. So this is also affected by the regular IAS 7 and also IFRS 9, which is financial instrument. Then the statement of changes in equity, this includes a transaction like shareholders issuing of share, buying of shares, and also changes in companies and equity, which is what the retained earnings is also affected by IAS 1 and IFRS 9, while the notes to the accounts provide the additional information on an explanation on the financial statement. And that is the reason why it has all the standard encompassed. It showcase and disclose some aspect on accounting policy used, assumption made, and so on. Now, to the next slide, slide, please. Thank you. Now, how IFRS drives transparency and long-term success of an entity performance. How do IFRS drive transparency and contribute to the long-term success of an entity performance? So, at the center of IFRS is IFRS 15, which changes how businesses recognize revenue. This changes help stakeholders better understand their revenue streams to make informed decisions. Next is IFRS 16, which redefines how leases are reported. Now, companies now recognize the lease liability and the right of use assets on their balance sheets. So these changes also provide a clearer view of cash flow and the financial commitment of an organization. Additionally, we have IFRS 9 and the IFRS 13, which helps companies to manage their risks related to financial assets and also report asset values. So these changes also improve transparency in financial statements. So together, this standard creates a clearer picture of companies' performance. To the next slide, please. So today, we are going to focus more on IFRS 15, which is not just ticking of compliance boxes. It's a game changer when it comes to transparency in revenue recognition. And also, revenue is one of the key focus for all businesses when it comes to stakeholders and then investors. You know, as an auditor, I have attended several AGMs of a company. You see, AGM is one of the most powerful meetings in an organization, and it's just like a tug of war. This is where you will see a learned and experienced investors or shareholders passionately in expressing themselves with impressive grammars, and the board of directors too, trying to defend their position. You know, all these arguments boils down to the key issues, like the net profits, the revenue, the dividend, and so on. You know, sometimes this is most of the places I learned some of my grammars, because there are some grammars you will hear, you can't let it go until you check the meaning. You know, it's somehow amazing sometimes. And for them, this business is not just about numbers. It's a specific part of their lives. So they can't afford to take it lightly. And that is the reason why you'll be seeing fight up and down. AGMs is always tough. People want to guide their interests. They want to guide their funds. They want to guide their jobs. So how will you feel as an investor or a shareholder if you realize that the financial report you are holding is not accurate, is not transparent, or is not in compliance? So how will you feel? I believe you will feel the same way they do too. You feel the same way. And that is the reason why we are going to focus exclusively on the revenue as part of the important and crucial standard today, IFRS 15. IFRS 15. Let's briefly talk about IFRS 15 and the old standard, which is IAS 8. In the era of IAS 8, revenue recognition demonstrated several challenges, such as complexity in accounting, in contract accounting, difficulty in recognizing revenue from service or other challenges. So to clear up this confusion, the International Accounting Standard Board, which is the IASB, collaborated with the FASB to build a new standard, which is IFRS 15, revenue from contracts with customer, effective on or before 1st January 2018. And then from that date, all other standards were suspended. So to the next slide, we have the what are the exemptions to this standard? That is, what are the scope and exemptions to IFRS 15? Number one is all IFRS 15 excluded some items, some areas of an industry. Number one is the non-monetary exchange between entities in the same line of business. Non-monetary exchange between entities in the same line of business, that is a barter trading. A barter trading between the same entity is excluded from the standard. Number two is the certain non-monetary transaction. What do I mean by certain non-monetary transaction? These are transactions that is not in exchange for cash, that is not in exchange for consideration, such as donations, contribution, gifts, are not within the scope of IFRS 15. And that is the reason why an association like NGOs are excluded from this standard, because their revenue is sourced by gifts, donations, and other likes. So the last one is financial instruments and other standard. A contract that falls within scope of other standards, such as IAS 39, IFRS 9 for financial instruments, and IFRS 16 for leases, are not subjected to this standard as well, because they have their own standard and their own guides. So they are not subjected to IFRS 15. Now, to the next standard, please. To the next slide, please. Let's briefly talk about the 5-step model of IFRS 15. So the most important thing IFRS 15 does is to introduce 5-step model for recognizing revenue, which, as we have seen on our slide, number one is to identify the contract with customer. Number two is to identify the performance obligation in a contract. Number three is to determine the transaction price. Number four is to allocate the transaction price to performance obligation. And 5 is to recognize revenue when and as the entity satisfied performance obligation. So if you want to determine how and when to account for revenue in that particular industry of yours, in any transactions you find yourself, all you need to do is to go through this 5-step model. All you need to do is to identify this 5-step model for you to what? To recognize your revenue. So let's briefly look at this revenue one after the other, which is number one is to identify the contract with customer. To identify the contract with customer. So what is a contract? What is a contract? And before you can identify contract with, you need to know what a contract is before you can identify. So what is a contract? Because of our time, let me just continue from here. A contract is a certain agreement between two or more parties. You can see the parties holding an arrow. That is an agreement. It is an agreement between two or more parties that creates an enforceable right and obligation. It creates an enforceable right and obligation. That is, it creates a binding right and obligation. So a contract can be in written form or in oral form, but it must be binding. Yes, in one of my classes on IFRS 15, a female participant asked how a contract can be in oral form. You know, we are all used to this writing, documentation, signing, approval before we can get a contract. So I remembered I cited an example using her as an example that if she enters a public bus, like a commercial bus, and the bus conductor says that the transport is 400 naira. And as at that moment of entering, she did not utter any word. She entered and sat. So later she brought out 300 naira and added it over to the conductor. And now ask her, what would she think will happen as at that process? What did she think will happen? So she said the conductor will not accept 300 naira because the agreement is 400 naira and not 300 naira. So I further asked her, that is the agreement written anywhere or is an oral form? She said is an oral form. So that settles the case. So you see, entering into agreements with those set of people, the commercial vehicle people is of a dangerous type because they are not in the same level as you are. You know, sometimes there are some substances they are into. So you have to fulfill the engagement in order not to be their culprit. I know that day, if she happens to be in that case, she has to pay the difference of 100 naira because the initial agreement is 400 naira and not 300 naira. So it shows that an agreement must be what? Must be in written form and of what? Oral form. So you see how flexible this standard is. So this standard makes it flexible for also those entity, especially where contracts, where formal contract is not always applicable. So it brings in even those people that are not in corporate world into the operation. So as I've said, contract can be in both written and in oral form. And it must be what? It must be binding. So we have two forms of contracts. Number one, as we have seen on the slide, we have combination of contract and a contract modification. Under contract, we have combination of contract and contract modification. For example, when you go to a shop to buy an item, you are entering into a sort of contract, right? But this kind of contract is an easier one because you can easily identify the buyer, you can easily identify the seller, and you can also easily identify what you are purchasing. So it makes it very simple to identify. But in most complex scenario where you have a company having multiple related contracts, like selling of cars, rendering of services at the same time, and so on. So recognition of revenue might be complex at times because of the multiple areas of recognition, the multiple area of the service. So IFRS 15 allow companies to combine this related contract into one to simplify the process of recognizing revenue through combination of contracts, and that's defined contract combination. That is the combination of related contracts, a car, services, all the likes that makes up the selling of cars, so it can be combined. That is number one. Then number two is modification, contract modification. You know, contracts of sometimes undergo changes like changes of existing service plan. It can be prices. It can also be quality of goods and services. You know, sometimes this modification can cause a lot of complexity in recognizing of revenue. IFRS 15 also states that also offer some guidelines too, that if there is a modification on any contract, so it gives a 3 option in order to be able to treat it. Number one is that the modification can be treated as a new contract. Number two, company can also modify the existing contract to reflect the changes. And number three, company can apply both approach. So this makes it flexible and transparent in IFRS to address this detail. So in summary, a contract is a certain agreement between two or more parties, and it creates an enforceable right and obligation. I also said a contract can be in written and in oral form. And also we have two forms of contract, which is combination of contract and contract modification. And under contract combination, when a company have a multiple and related contract, IFRS 15 permits that they should combine the interrelated contract to be one in order to what? To make it simple for recognizing revenue. And under contract modification, there are three options being given by IFRS 15. Number one is to treat the modification as a new contract, and number two is to modify the existing contract in order to reflect what the changes, and number three is what? To apply both approach. That leads us to the second step of identifying revenue under IFRS 15. Sorry, the next slide, please. Yes, no, but the second step is identify the performance obligation. Identify the performance obligation. As I've said in my introduction, that performance obligation is a certain promises in which a contract, a customer, you promise your customer to deliver. Is a promise that you will deliver to your customer the goods and services. So under performance obligation, we have two types. We have the distinct goods and services, as it is in our slide, and we have series of distinct goods and services. Let me quickly break that down. Let's assume you have a shop, you are selling ladies' items. So a customer requested for a bag. So you are recognizing the revenue for the bag separately. So this makes it what? A distinct goods or services. It makes it what? A distinct goods or service, because it's a standalone item on its own, and what? It fulfills a specific purpose of purchase. So how does it make it a series of goods and services? Let's quickly explain that. You also have a product online. Our customer requested online for a bag, and alongside with what? A dispatch rider, your dispatch rider, to convey the bag to our own destination. So we are now engaging the bag as what? A distinct goods and service, a distinct goods on its own. Then the dispatch rider is a service, so it's what? A distinct service on its own, because two of them can be treated separately. Now, the combination of two distinct goods and services makes a series of distinct goods and services. So let's use a car dealer as an example. As a car dealer dealing with new cars from the US, shipping, customs, insurance, a series of goods and services, because they are the one that comes together to bring the car to your location. When you purchase anything in abroad, let's say the US, you have to look at the shipping costs, the custom costs, and all the like. So all this cost makes a series of distinct goods and services. There is an adage in Yoruba that says, that is, if a snake draws, the shells also follows. Which means everywhere you see a live snail, you will also see this shell with it. And that is how series of goods and services operated. So a contract usually clearly states goods and services that should be what? That should be transferred to the customer. Now, note here, where there is no transfer of anything to the customer, then there is no performance obligation. Let's note it. So that leads us to the next step of the 5-step model of IFRS 15, which says, let's identify, you have to determine the transaction price. Determine the transaction price. So transaction price is an expected amount of consideration that you are expected to receive under that contract to deliver that goods and services. So how can we determine the transaction price? The transaction price can either be a fixed or what? Variable. So it can be fixed when the customer pays exact amounts you agreed upon. Then it remains fixed. This is the amount you say you are saying your goods. Then I pay. So it's not becoming a variable transaction price when there is a changes in consideration due to maybe future events, for example, amount of consideration can change due to discounts, bonuses, it can be rebates, it can also be a refund or various incentives as well. So note, please note this again, that if a contract now involves a non-cash item, like goods and services, instead of cash, instead of form, this item needs to be included in the overall value of the transaction. And that is where IFRS 13 comes into play, which covers fair value measurements. So in this situation of a transaction involving cash, non-cash item, so IFRS 13 stated such that non-cash item value should actually be determined and included in the total transaction value. So this is to ensure that a financial statement reflects the economic value substances of transaction and provide what a clearer picture of the financial statement for the users. So let's briefly look at the fourth step model of this standard, which means allocate transaction price to the performance obligation. Here I would like to explain this step with a real life scenario. I really love shoes a lot, and that's the reason why I have to use shoe. One day I saw a fantastic deal at a favorite store. They were offering a special promo, which is you buy one pair of shoes and get one free socks, just the way you see it on the screen. The transaction price of that shoe, as at that time, is 100,000 naira, and I'll get the free socks. You know, it's just an incredible offer that you can't lose, because any free things, we like it a lot. So from the accounting point of view, the shop has two obligations. From the accounting point of view, the shop has two obligations, which is what? The shoe and the socks. And I will also be able I'm also being able to identify the transaction price, what is the price I'm paying, which is what? 100,000. Now, from the same scenario, I can also identify the contract. The contract is the purchase of shoes to get the free socks. So from one scenario now, I'm able to identify the 3-step from the 5-step model of IFRS 15. Now, how will I allocate the transaction price to performance obligation? How will I allocate the transaction price to performance obligation? Under IFRS 15, you cannot allocate 100,000 naira for shoe and nothing for socks. Instead, you will do by prorating the transaction to the what? To the related standalone selling price. So the standalone selling price here is basically the price at which the shop sells those goods separately, irrespective of free or no free. At least she got the material from somewhere and she pays. So you are going to base the proration on the standalone price. So on this scenario, I was able to get the standalone price, which is 100,000 naira for shoe and 5,000 naira for the free socks, which make it what? 105. So we need to allocate the 100,000 naira which I paid to the what? To the real life price, which is the standalone price of 105. And that leads us to this little calculation here, where we are trying to allocate the 100,000 naira, which is a standalone price, divided by the total standalone price, times 100,000 naira, which is my own transaction price, to get what? 95,000 naira for shoe. And we do same for the socks as well. 5,000 naira divided by 105 times 100 to get for shoe. So under IFRS 15, the transaction price for shoe will be 95,000 naira, while the transaction price for socks will be 5,000 naira, totaling the 100,000 naira which I paid for shoe to get the free socks. Okay, so let's go ahead. So we want to go further here. Let's now imagine that the promotion was successful, and immediately I'm paying that 100,000 naira. They went out of socks. The stock, they have a stock count for socks. So there is no free socks again. And I was told to come back the next day for the socks. I was told to come back the next day for the, but they've already collected the money anyway. So that leads us to the 5th-step model of the 5-step model of recognizing revenue. Please, to the next slide, please. To the next slide. All right, thank you. So from the 5th-step model, we have two different ways of satisfying performance obligation, satisfying and recognizing revenue. Number one, we recognize revenue over time, and number two, we recognize revenue at points in time, over time and at points in time. So back to our illustration, let's assume that that promo was done as at 31st December of that month. And I was told to come back the next day, which falls into another month. Now, how will the shop recognize revenue in their books? How? How will they recognize revenue in them? I don't want to, the time is already fast spent. Let me just continue. So according to IFRS 15, revenue can be recognized only when the performance obligation is being satisfied and goods were delivered to the customer. So in this case, I was only given the socks. I was only given the shoe. And I was told to come back what? The next day, which is what? The next year, because they were trying to push out all their old stock at the end of the year. So they have run out of stock. So they told me, don't worry, you come the next day. So the next day now happens what? The next year. So how are we going to treat this transaction? How are they going to treat as the revenue as at that date, while the remaining balance of 5,000 naira we got into contract liability? Hope I'm still audible. Hello?
Yes, we can hear you.
Can hear you.
Okay, thank you very much.
Yeah, go ahead, I hear you.
I have a distraction a little bit. Sorry. So the remaining balance of 5,000 naira will go into contract liability as the liability in the account until the stock is being given. So let's briefly look at the accounting principle. Sorry, of the show. The next slide. Hello, so hope I'm still audible. All right, thank you. So let's see how the entries is being accounted for. Under overtime of recognizing revenue, as at 31st December of that year, they collected 100,000. The seller collected 100,000. So they have to debit their cash and bank account for that 100,000, and credit was 95,000 naira as revenue, being what? The performance obligation being satisfied by me, and credit contract liability for 5,000 naira being the one that they are yet to satisfy. So let's now assume eventually the performance obligation is being satisfied. Then they will now debit back the contract liability with the 5,000 naira and recognize their revenue by crediting the revenue accounts. So let's briefly look at the overtime of recognizing revenue. That leads us to the next slide, please. The next slide. The overtime of recognizing revenue. The next slide, please. Let's be fast because of our time. Yes, the point at point in time, you know, when assuming I got the shoe and the socks at that point in time as I paid, they will recognize 100% of that transaction. They will debit the account with 100,000 immediately and credit revenue. So these are the ways in which revenue is being recognized. Hope I'm communicating. So there is another thing. I know a question might come up asking for what is the difference between deferred revenue and contract liability, because that's most of the questions being asked. So why are we not using deferred revenue? Because it's an on-hand revenue. Why are we not using deferred revenue, but contract liability. Yes, deferred revenue is the same, serve the same purpose as contract liability under IFRS 15. But contract liability is being used in this context because we are dealing with recognition of revenue from contract with customer. So we are using the contract as what? As a liability here. In this context, we are using contract liability, where deferred revenue is also used to represent an on-hand revenue, yes, but in this context, contract liability is applied. And this is just like a fair value too. When you look at fair value, it's all about market fair value measurement under IFRS 13, right? Then we also look at lease reassessment, also do with the changes in the lease term to reflect the current condition of a lease agreement. So it's also boils down to what? The fair value. And when we look at IAS 16 too, revaluation of asset, we are also turning it to be what? To revalue to what? So based on what? The market value, also to be what? The fair value. So we are still talking of the same thing, but different times is being used in different contexts. And that is how deferred revenue is, and the contract liability. So let's briefly look at contract cost. Sorry, the next slide. Yes, let's briefly look at it. We have two types of contract cost under IFRS 15. We have cost to obtain a contract, which is the cost that is incurred for getting a new contract, e.g., as it is on the screen, we have the sales commission, the lease, the legal fee, the agreement fee, and so on. And we have costs to fulfill a contract. These are the costs the company needs to pay from start to finish of the contract. So example is that you have to buy the material, the labor, you pay the labor, and also other expenses, direct expenses that are required for the completion of the contract, and so on. So let's quickly look at the recognition of and disclosure. Let's look at the disclosure on IFRS 15. What are the disclosure? We have number one, we have to disclose the method we use in recognizing revenue. We disclose the method used in recognizing revenue. So we look at what are the, we look at the timing of the revenue, whether maybe is an overtime or at point in time. We also look at the performance obligation. You disclose the list of your performance obligation, and this will help the stakeholder to understand what triggers the revenue recognition. So we also disclose the contract modification. You have to explain that these are the modifications done. So what triggers the modification? Is it discount? Is it a rebate? Is it a refund? And so on. So all this needs to be explained, needs to be disclosed in the financial statement for clearer picture, so that the financial owners will be able to know this is what has happened, this is what has transpired over the years. So let's quickly look at to the next slide, please. To the next slide. Let's look at the next slide, please. To the next slide too. So let's look at the software available for recognizing revenue in accordance with IFRS 15. Number one, we have the Oracle Revenue Management Cloud. We have the SAP Revenue Accounting and Reporting, which is RAR, and we have the Workday Revenue Management software. These softwares are applicable for companies that have a lot of revenue streams. In order to be able to simplify the process technologically, you have to apply some applications in order to have a smooth work. And that is the reason why all the softwares are applicable. So let's quickly look at the takeaway for today. Let's look at the takeaway for today, which is the next slide. So under IFRS 15, revenue is recognized when performance obligation is satisfied. That is certain. That is, performance obligation has to be satisfied. And why unsatisfied performance obligation should be what? Should be recognized as a contract liability in the financial statement. So the next slide, sorry. So in conclusion, the real power of IFRS is using this standard is not just for compliance, but to help your company for growth, attract more investors, and improve financial performance. So thank you very much for having me today. Thank you very much. So over to you, please.
Thank you so much, Toby, for these good presentations. I want to believe that the time given, you actually did a lot to try to meet up with the time, and for the use of the IFRS 15 to buttress the points on strategic values of IFRS, especially in the area of disclosure and the various other areas. Professional colleagues, please, I would like to know if we have questions that we would like to attend to before we end the technical session. Please, if you have questions, please, can you just signify so that we know whether we can take like two. Okay, I can see some hands already. Okay, so can we take, I think we have like three. Okay, I can see 3 hands.
Okay.
So make it 4 now. So please, let's just, because of time, you know, I always say that every good thing is challenged with time. Please, can we have to Lokwe Ogushi JCA let's have your question. Please just let's be snappy about it so that we can move to other things after just next 10 minutes.
Okay.
Thank you very much, my chairman. So my question is, thank you very much for the very, very, very interesting presentation, ma'am. I am a financial reporting enthusiast. So my question is based on the fact that revenue, I have heard several a school of thought that says revenue is recognized when there's transfer of ownership to the after the completion of transfer of ownership to the buyer. So does this in any way contradict our IFRS 15? Because I have always stuck to the IFRS 15, the principles of revenue recognition according to IFRS 15. But I would like you to actually shed more light on that. Thank you very much, ma'am.
Okay. Yes. Thank you very much for the question. Yes, according to the 5th step model, which says revenue is being recognized when, as the performance obligation is satisfied. So when you transfer the goods to the customer have not yet satisfied that is okay with the goods or product, then you can recognize revenue according to IFRS 15. You can transfer the goods, fine, but I've not attested, because you can even bring it back that you don't want again. It's possible, and that is the reason why there is a grace. There are some grace when you receive some products that will give you a grace within this time and this time you can't return again. So when you lapse that period and you don't say anything, that is, you have concurred. So even if you transfer, if you are not satisfied according to the standard, then you can recognize revenue. Hope I've been able to do justice to that. Hello? Hope I'm audible.
Yes, ma, you are, and thank you very much for your very concise response.
All right, thank you. All right. Any other questions?
Okay, I don't know whether you can hear me. Can you hear me, Bruce?
We can hear you. We can hear you.
Okay, please. Those that have questions, maybe we just probably take all the questions.
Just take like 2 or 3 questions together, and just like 2 or 3 questions together. Then you answer it once. Any other question, you can send it.
Okay, please, all that have questions, please just unmute and please just ask your questions.
So sorry, I think we should take it. We have 2 people here. Let's just take those 2 questions. Samuel Debumi and Oluwaseun Ojediran. One after the other. Yes. Samuel first. Thank you.
Okay.
Thank you, Ma. Thank you, Oluwatobi, for the presentation. Actually, I wanted to clarify under step 2 that identify the performance obligation. Now, if I'm a car seller, I also do the business of delivery. So, as you said, there should be between the goods and the services. So now, if
sorry, you are not audible. You are not audible, please. You are not audible.
Okay.
You are not audible.
Okay. Can you hear me clearly now?
Okay. Yes, I'm trying to. Okay, you can go ahead.
Okay, under identify the performance obligation, I'm asking the question that does the standard actually allow you to record the the goods and the services that you offer together in your book?
Yes.
Now, I'm using an illustration like if you are a car dealer now, you sell to your customer that comes to you, and then the customer actually requested that you also deliver the goods to him. That delivery is a service, and then for you, the selling is the goods. Now, does the standard actually allow you to record
Yes.
both and the service?
Yes.
Now, if the
Thank you.
standard allow you,
Yes. Under
what
combination of contracts, I think I explained that under combination of contracts, you have combination of contract and contract modification. So you can combine related contracts, just like the car and the services. You know, they align together to provide satisfactory. Sorry, am I still audible? So they align together. They are
Yes, yeah.
they are series of related transactions. They must be related. As you have said, the car and servicing, you know, they are related sets of transactions. So you can compile it together to recognize it in order to what? To streamline your revenue. So in order to make it simpler, then you can combine. It's under combination of contracts. Under identification of under contracts identification. Hope that is okay. Hope that is fine. Hello.
yes,
Thank you. I
Yes,
think we should take the last one.
Okay.
Yeah.
Oluwaseun.
Oluwaseun, please, let's quickly take your question.
Thank you very much. Good afternoon. Thank you, Madam, for the presentation.
Okay.
My question is related to IFRS 17. As specifically, I wanted to know by preparations of the financial statement as they apply to IFRS 17, do we need to use also the element of IFRS 15? Because there seems to be a bit of relationship and somewhat of a contradiction. I don't know if you can shed more light into that. And also, in case of deferred acquisition costs, there is a way by which is addressed under IFRS 17. But having to know now about IFRS 15, I would like you to explain in a short context what can be done in order to bridge the gap between the two. And finally, in terms of disclosure, related to IFRS 17, can we also introduce element of IFRS 15 into it, or we separate the whole conceptual framework? That's what I'm trying to understand, because there is a lot of relationship, but a bit of a contradiction at some point when it comes to presentation. Thank you very much.
All right, thank you very much. From my slides, I make mention of some exemptions to IFRS 15. I said there are some financial standards, there are some standards that are exempted from IFRS 15. And I made mention of insurance too. You know, there are some standards that have already dealt with their own recognition. So you don't need to go back to exempt it. You don't need to add it in other standards. So any other standard that pertains to contract revenue, they could have been dealt with there. So, and that is the reason why you have financial and other standards. They are what? They are exempted. They are exempted from it. So you treat it as the way it is in IAS 7. You know, you can't be double counting. They could have told you this is how to do it. This is how we do it. This is a standard. This is the context here. Then you follow this. This is meant for contract with customer, and you basically treat everything you have under contract with customer. Then the other one we treat itself differently. They also have a guideline that will follow it differently. So any other standard that is not within the scope of IFRS 15 should be dealt with in their own standard. So
okay, well noted.
All right,
thank you very much, madam. I'm grateful.
Okay, thank you.
Thank you so much, our speakers for today, Madam Toby Okoma. Thanks so much. We appreciate you.
Thank you very much.
It's so obvious that there are so many things that we have to discuss about IFRS, and I want to believe if we have opportunity sometimes later on, we'll be able to bring you back to come and discuss with us on subject matter of IFRS. Thanks so much for this presentation of today. I was actually hoping that I'll get some of those your grammar that you got at various ages. I understood what you are trying to say. Those